We work for money, but did you know that your money can also work for you? We're living in a world where petrol prices are keeping us outside of our cars and stock markets are taking a hit because of wars. When we turn for advice, we don't get the right one. Paise udao nahi bachao. But turns out that even our savings aren't safe. Because thanks to the rising rate of inflation, our savings amount is really losing value sitting in our accounts. So what's the solution? A promotion, जो boss से नहीं मिलता. Time for a side business, जिसके लिए office से time ही नहीं है. But what if I say that in our quest of working for money, let's not forget that our money can also work for us. So there's no need to be hyper. A possible solution can be passive. Yes, you heard it right. और doubt हो तो back करके देख लो. Hi, my name is Sunita Kareer and we're going to be talking about passive funds and investing in this video. Now, when I talk about terms like mutual fund and investing, the first thought that comes to anybody's mind is mutual fund investments are subject to market risks. Read all 2 related documents carefully. Market risks. The word alone rings alarm bells in our minds. Let's see what you feel about this. Do you save money?
Yes, I do.
Yes.
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 How much?
I would say at least I try to save 10 to 20%.
30 to 40% of my salary.
Approximately what? 30 to 40%?
20% of my salary.
40% of my salary.
10 to 15%.
Do you invest in mutual funds? Which schemes?
I mean, it's a good mix of equity and debt only, I would say. Again, a same sort of component, large cap, mid cap and small cap.
No, I haven't started yet.
Yes. Low risk funds.
Mutual funds investing in blue chip stocks, or some of them have the hybrid schemes, etc. Mostly, mainly equity linked schemes.
Now, let's shut these alarm bells with information. Active facts about passive funds. So first things first, let's start with knowing about the main kinds of mutual funds, which is active and passive funds. Active funds are actively managed mutual funds or schemes that are run by fund managers who try to outperform the stock markets for more returns. There are different categories of funds like large cap, mid cap, small cap, balanced and so on. In simple terms, the aim of active investing is to beat the market. But with passive funds, fund managers aim to match the stock market indexes and not outperform them. There are different categories of funds like index funds, exchange traded funds, which are popularly known as ETFs. There's Nifty Mid Cap, Nifty 50 and so on. Since the fund only replicates an index and does not have an active fund manager, it carries no human decision-making bias. In simple terms, the aim of passive investing is to meet or match the market. Do you accept that equity investing means exposure to risk? When the entire market goes up, your investment returns also go up, and when the market goes down, so do your returns. So expect short-term return fluctuations, especially during periods of market ups and downs. अगर ये सब इतना ही simple होता तो आप लोग ये video नहीं देख रहे होते, right? That's why all of this demands an expert fund manager who can make decisions on your behalf. Like which stocks to buy, when to buy, which to hold, which to let go. And that's a lot of work, isn't it? You know, historically, it is observed that markets do rise over a period of time. So if jaldi nahi hai and you're happy to grow your money with the market in the long run, then no need for you to chase the market like crazy. Just sit back and let passive investments take care of your long-term financial goals. Now, when we invest in the stock market, we normally purchase stocks of certain companies. However, investment in a passive fund is like investing in an entire section of the market. For example, if you invest in an auto ETF, a passive fund, it doesn't invest in just one or limited automobile companies, but invests in an entire auto sector by investing in a portfolio that tries to replicate an automobile-specific index, like the Nifty Auto Total Return Index. Let me explain this in more detail with an example. Now, in the year 2000, the number of cars produced in India was 5,17,957. In the year 2021, that number shot up to 36,31,095. So the rise in demand and consumption of cars clearly leads to the growth of the automobile industry. This means that your investment could grow as well and can help you beat the impact of rising prices over long term. Now, when your neighbors buy a new car and show it off to you, you know what to think. Celebrate, but But don't be jealous, because while his car's value will reduce with time, thanks to his purchase, your money could grow. And since we're talking about the results, I'm sure you guys would want to know about the risks as well. So while investing in actively managed funds, even if the overall market goes down, there are chances that the stocks selected in your portfolio might be performing well. But passive funds, on the other hand, are exposed to the total market risk. What does that mean? Since it tracks the entire market, when the market goes down as a whole, so does your investment value. Another possible challenge is the fact that passive investment isn't flexible. So when the market is changing, one cannot change the stock selection and witness portfolio restriction. They're tied to the market without any possibility of adjustments or modifications. But these limitations may also work as a positive solution in the long run. Don't believe me? Okay, let's see, who do you guys normally like to believe? Do you discuss your investments with your friends and family?
Yes.
Yes, I do.
Not really, once in a while maybe.
Yes.
Yes.
Who would you go to for financial advice? The internet or somebody trusted?
Somebody I trust.
Nobody, to be very honest. I mean, since I'm not a big investor, I don't really think I need to be consulting with anybody.
Somebody I trust.
You know, there's an old saying, पैसे क्या पेड़ पे उगते हैं, काश उगते. But now you know that passive investment में पैसे actually पेड़ की तरह ही eventually उगते हैं. But a tree doesn't normally grow by itself. It needs constant and consistent care. Now, how to do that in a passive investment portfolio? The smarter way is through systematic investment plan or an SIP. For example, if you start an SIP of 5,000 rupees every month in a passive fund whose unit cost is 50 rupees, so you're buying 100 units of that fund. And now when the market grows, because of which the stock prices rise and the unit cost increases to 55 rupees, the value of your investment also grows. However, in case of a market downturn, if the unit costs come down to 45 rupees, then while making the next SIP installment, you're buying approximately 111 units of the fund, 11 units more. So when the market goes back up, it balances the investment with 11 units more worth of returns. Similarly, during market downturns, with an SIP, you get to purchase more units of your fund automatically. And if you continue your SIP for long, this can be highly beneficial. But investments come with an expense ratio. Let me explain you how does that work. Now, expense ratio is the cost that is incurred while managing active funds. Naturally, it is higher because it takes loads of research, analysis, expertise to capture market's movements and generate additional returns, versus in passive investing, the fund manager just has to mirror the index, which generally makes the cost involved low. So, the expense ratio of passive funds is often much lower as compared to that of similarly themed active funds. Can't remain active in the market and do not understand its constant changes? Well, that's exactly what will win you the game. Just remain passive and chill while your money grows with time to pay for your future bills. Confused which stock to choose? Then don't choose. Let the entire market itself work for you. So that brings us to the end of our episode and hopefully to the start of your passive investment road. And don't worry about riding alone. We'll be back with For Your Investments the next time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.